Now, the best investment in the world is the investment in your mind. So, hello everybody, welcome to our Bursa Malaysia webinar. In this session, we're going to talk about introduction to exchange traded bonds and Sukuk. Okay, my name is Shen Chu, and with me, I have the renowned speaker and author with me, which is Ian Tai. Thank you so much for joining us today.
Hey, thank you.
All right, so now some of you here may not have invested in bonds before. I think most of us, when we buy bonds, right, usually we buy through the unit trust kind of bonds. All right, am I right? Like we buy bonds funds. You know, I have hardly met people who really go to subscribe to bonds, because I've heard that require you to have 3 millions kind of like a net worth. Am I right?
Yes, of course.
Yeah, so like for small investor like us, we may not be able to buy bonds yet, but today we're going to talk about how, as retail investor like you and I, can participate in the bonds in the Bursa Malaysia market. Now, maybe you don't know that you can buy bonds from Bursa Malaysia market, but today we're going to introduce to you how you can buy bonds on the Bursa Malaysia market through this instrument called Exchange Traded Bonds and Sukuk, ETBS. So today our speaker Ian Tai will share with you exactly how. Now this is a special webinar because usually, you know, we do Bursa stock webinar is during Tuesday, but today we have a special request to do the bond webinar, so we organize it on a Thursday instead because we don't have any other date. All right, so disclaimer. Whatever we share in this webinar is only for educational purpose, so in no way that we recommend any buy or sell to any asset class as well. Okay, so if you decide to buy or sell anything, you do it at your own risk. So as usual, we have designed a series of webinar for you organized by Bursa, and now we are coming to the last month already. Next month we have Pauline Yong talk about how to invest rationally in an irrational market. This is the first Tuesday of the month. Then the following month we have Ivers Ui, who will conduct a Chinese webinar on the second Tuesday of the month, which is on the news analysis in Chinese. And then lastly, the intermediate webinar is already over, and we'll of course look forward to more sessions in the future. Okay, that will happen on the third Tuesday of the month. Now, who is Ian Tai? Okay, if you have come to our previous webinar, he was here with us to talk about dividend yield and to talk about other PE ratios. So today he's going to talk about what is ETBS. So he is a content producer for kclau.com, which is the leading personal financial blog in Malaysia. He's also a columnist for the Fifth Person, Value Invest Asia, and majalah labor.com. Okay, he himself is a dividend investor, so to him, not to be too aggressive in the stock market, but to be very conservative, building sustainable income, building sustainable wealth and income through dividends is his style of investing in the stock market. So every year he collects 8 to 9 months in dividends from personal stock portfolio in every year, averaging around 6% per annum in dividend yield. That is a remarkable return as a dividend investor. So while the capital gain all is come in the form of like bonus.
Yes, of course.
Yeah, so that is Ian Tai, which is a conservative investor. Today he's going to talk about exchange traded bonds. All right, ETBS. All right, so take it over, Ian.
All right. Once again, thank you so much, Shane, for such an enthusiastic introduction. It's always my pleasure to do this session with Bursa Malaysia. And of course, today I will be sharing what I've actually gathered from about this particular topic, which is exchange traded bonds and Sukuk. All right, so it is something which is listed on Bursa Malaysia, but it's actually not so well known. All right, what most people know is that you can actually buy stocks in the stock exchange like Bursa Malaysia, but not many people know that there is such a thing called exchange traded bonds and Sukuk, which is a type of bond where you can actually buy and sell it in Bursa Malaysia. So we're going to explore this, we are going to dive into this particular topic in greater detail. So let's get into it. I've actually prepared quite a number of materials for today.
So you tell us what is bond first, right?
Yeah, that's exactly what we are going to do.
Yeah, because before you before you go to exchange traded bonds and Sukuk, we must know what exactly are bonds.
Okay, so now we are going to dissect the forwards, exchange traded bonds and Sukuk. So in order to know what is that first, so let's talk about the first thing. Let's talk about the first word, which is bond. So what is a bond? Okay. Now here's the definition of a bond. Okay. Let me give you an example so that you can actually understand how this bond thing works. All right. So let's take a look at the screen. Of course, everyone is looking at the screen. If not,
Yeah.
what else would they be looking at, right? All right. So
at your face.
All right. So here's the example. So we have a company. Okay. Let's say, for example, you are the owner of the company or you are the CEO of the company, and you want to undertake a project. Okay. So a company wants to undertake a project, and you kind of like short of funds. So let's say you have actually estimated that the project is going to cost about 100 million ringgit. All right, you have 50 million ringgit in hand, but you seem to be short of another 50 million ringgit. So what do?
I can do rights issue.
You can do rights issue.
Take money from the shareholders.
Yes, of course.
I can do private placement.
You can do private placement.
To take money from the other investors.
You can also go to the bank and borrow money.
I can go to the bank and borrow money.
Or you can actually issue a bond.
Okay, so this is the fourth way.
Yes, so this is the fourth way, which is to issue a bond to raise the shortfall of the $50 billion. Okay.
So bond is a debt or is an equity?
It's actually a debt.
Oh, so bond is a debt.
All right. So let's say, for example, I'm going to issue a bond and I'm going to sell the bond. Let's say, for example, to Shane. All right. I'm the company CEO. I need to raise money, $50 million. And Shane is a very rich investor and I'm going to issue him a bond. And he seems to be very interested to get it. All right. So what I'll do is that I'll issue him a contract, which is known as a bond. All right. Inside the contract, it states the principal sum. All right. Let's say, for example, Shane wants to buy, let's say, $5 million of bond from me.
Okay.
All right.
So if I have 5 million, of course.
Of course, he's rich. So let's say the principal sum is 5 million. All right. And I'm going to promise him a tenure. Let me say, okay, Shane, you're going to give me 5 million. All right. And this 5 million, I'm going to give you it's like a loan whereby it has its tenure. Let's say the tenure is 5 years. Okay. And of course, Shane would like to have some form of interest because he's actually lending me the money, right or not? So I'm going to give you a very good interest rate of, let's say, 5%. Okay. So as a result, Shane will give me 5 million. I will give him a bond, which is like a loan contract whereby it states the amount of money he lent me, which is 5 million. All right. And the contract is for 5 years, whereby the interest rate is 5% per annum, and I'm supposed to pay him the 5% interest, all right, in order to compensate him, to reward him for lending me the 5 million. And after the 5-year tenure, I'm supposed to return the capital back to Mr. Shane and thank him for financing the project. All right. So that is actually an example of how bond actually works. So it is actually a debt contract.
So the bond issuer is essentially borrowing money.
Yes.
Yeah. And the investor to buy bonds is actually lending the issuer the money.
Yes, exactly. So if you treat it that way, that means I am the debtor, you are the creditor. All right, I'm the borrower, and you are I'm the borrower and you are the lender.
Yeah, it's like I think recent case like one NDB okay, need money, so they issue bond, and then the institutional investor go and buy the bond. That means they essentially lend one NDB the money to buy into to undertake the corporate activities.
Correct. You may say that. All right. So that is the essentials of how a bond actually works.
Yeah.
It's basically a lending thing. All right. Next. Now there are different types of bonds in the market. All right. So I know that in my webinar slides, all right, I mentioned that there are 4, but here I'm going to give you 5. All right, which is one additional bonus from what is being promised. All right. So here are the 5. It's actually as followed. So the first one is called the fixed rate bond. Second one is floating rate bonds. The third one is zero coupon bonds. The fourth one is convertible bonds, and the fifth one is perpetual bonds. Okay, so we are going to dive into them, and we're going to take a look at each and every single one of them and see what are their differences. Okay, so this is an introductory class of what is actually a bond. Let's take a look at the first one, which is fixed rate bond. Okay, so just now I have actually mentioned, all right, the example very clearly with Shane Chu here, whereby he's the lender, he's the rich guy with money, and I'm the company that needs money. All right. So what happened is that let's say, for example, he is the one who buys the bond. Okay. All right, and I'm the one who issues the bond. So a fixed rate bond is something like this, assuming that he is actually going to give me $5 million. All right, whereby the principal sum of the bond is 100 ringgit. All right, so let's take the principal sum, 100 ringgit. He give it to me. Okay, and I promise him a 5% interest. So promise. All right, every year I will have to fork out for every $100, 5 ringgit, and I have to pay Mr. Shane. All right. So if you look at the graph below, the chart below, that is how the cash flow looks like for a fixed rate bond. Okay. Now, assuming that the loan tenure is not 5 years, but it's actually 3 years. So here's how it works. At the start, Shane will actually give me $100. Okay. So I will receive $100. After 12 months later, all right, let's say the coupon rate or the interest rate is 5%. Therefore, I have to give Mr. Shane his first income, which is 5 ringgit. All right. 12 months later, year 2, I have to give him 5 ringgit in interest. And at the third year, I still have to give Mr. Shane 5 ringgit in interest. And on top of that, I have to actually repay my loan, repay the debt contract by taking the $100 and give it back to Mr. Shane. All right. So in total, Shane has actually lent me $100, and he has actually received $5 plus $5 plus $5, which is $15 in interest income, plus his capital back, which is $100. Okay.
So if you invested, say, 1 million in the bond that gives 5% yield a year, then essentially every year you will take back 50,000.
Yes,
until the maturity, you take back the principal sum.
Yes, you will take back lah. I will have to give lah. All right, because I'm the company and you're the lender lah. Right? So this is actually the fixed rate bond. So why is it called fixed rate? Because the interest rate for this bond is always fixed at. It has already, the contract states that it's 5%. Means whether market goes up, market comes down, 5%.
Okay.
Okay.
Right. So let's talk about the risk lah. You see, a coupon rate of the bond given in your example is 5%.
Okay.
How risky is this bond as an asset compared to fixed deposit and compared to equities?
Okay, that one I will have to explain it after I have go through the 5 things.
All right.
Because that is actually right at the second.
Okay.
Yeah,
Right.
I prepared that. I prepared to answer a lot of things. But
Okay.
I think for our audience, it's best to know the bonds first.
All right.
So that we can have a much more meaningful discussion at the second half of this particular webinar. So let's go through this. Now, the second type of bonds is floating rate bonds. Okay. So like just now, for example, the interest rate is fixed at 5%. So for the first 3 years, 5%, 5%, 5%, right? But there's such a thing called floating rate bonds, which is based on, let's say, for example, in this case, the KL interbank offered rate. All right. So it depends on what is the offer rate plus a fixed percentage. So let's say the fixed percentage, let's give it, let's say 4%. Okay. Let's say the X% that you see on the screen is 4%. And then the KL interbank offer rate is actually, let's say it's giving out 1%, for instance. Then it will be 1% plus the fixed 4%, which is 5% in interest rate. So if that happens in year number 1, they have to give Mr. Shane his due interest income of $5. But if let's say the KL interbank offer rate has dropped, let's say it's nothing, all right, it's 0%. Then of course I have to compensate Mr. Shane $4, the plus 4%, which is $4. And of course, if let's say the the CLIBOR or the KL interbank offer rate has increased to 2%, so it will be 2% plus 4%, which is an X percentage, all right? And I have to give him $6. And of course, if let's say the maturity is 3 years, then at the end of the third year, I have to give back whatever I owe to Mr. Shane, which is the $100 in principal sum. So Why is it called floating rate? Because the interest rate that I have to compensate Mr. Shane differs according to the KL Interbank offer rate. Okay, so let's move on to the third one. Zero coupon bonds. Okay, so what does it mean? Now, zero coupon bonds is like this. All right, let's say, for example, the principal sum is $100. Okay, so that is the value of the bond. All right, so zero coupon means to say there's no interest rate. All right, so let's assume Shane has $1 million. All right, I want money from him because I want to start a project. All right, so I tell Shane, hey Shane, can you borrow me $1 million? Will he just give me 100? Would Mr. Shane be so kind enough to actually give me the $1 million? And 3 years later, he allows me to pay him back at the same rate, which is $1 million. I believe Shane is like
that depends on our friendship.
I believe Shane is one guy who can lah, but let's assume that he's not lah. Okay, let's assume that he's not. Then Shane may say, okay lah. All right, I'm willing to take a chance on you, but instead of giving you 1 million, right? How about this? I give you, let's say 80. I give you 85 lah, 850,000. So you lend me 850,000. I do the project. Then after 3 years later, the 3 years, right? I don't need to receive money from you. Wow, okay, take 850,000. 3 years, don't need to see Shane. All right, but at the end of the third year, I have to give back to Shane $1 million. Okay, so this is actually how zero coupon bonds actually work. All right, which is why zero coupon bonds, when they are offered, they are always offered at a discount as compared to its principal sum. All right, so that's the third one. Fourth one, convertible bonds. What does this convertible mean? So now let's say Mr. Shane, he said, Ian, actually I take a look at your project and your company. Your project and your company is very interesting. Do you offer me a chance to become your buddy, your shareholder? Okay, so that's where the convertible comes in lah. All right. So meaning to say, Mr. Shane, he's so rich, he will give me $1 million at the start. And let's say, for example, this is a fixed bond, all right? Just now, like type number 1, we got the fixed rate bond. So I receive $1 million from him. Every year I have to pay Mr. Shane $5, the $50,000 in interest to Mr. Shane. That's his interest income. That's year 1, year 2, and year 3. And after year 3, let's say, for example, Mr. Shane says, Ian, I don't want to invest in your company. Fine, law. I take the $1 million that I owe Mr. Shane, and I give it back to Mr. Shane. But let's say, for example, Mr. Shane says, "Hey, Ian, I like your company. Can I become your shareholder?" Then instead of giving back the $1 million in capital to Shane, I will start to calculate. Okay lah, this is the rate. All right, this is the rate that this is the amount of shares that is worth equivalent of $1 million, and I will give it to Shane. So instead of receiving back his loan capital, all right, he may actually get shares. He may be compensated with my company shares instead, so that he is now a brand new shareholder of my company. So that is actually convertible bonds. But of course, can the shares be converted only at the end of the third year? Not necessarily. Which means to say, in that 3 years period, let's say this bond is only for 3 years. In that 3 years period, at any point of time, depending on the contract, he can actually slowly convert some of his bond holdings into shareholdings. All right. So that is like a sweetenizer lah, just to attract you to actually lend me your money.
Okay, so this is like a loan stock,
sort of lah.
Yeah, convertible loan stock. Right, which is also traded on the Bursa Malaysia.
Correct. So we have the final one, which is perpetual bonds. Okay, why is it called perpetual? Because there's no maturity date for it. That's why if you see the third year onwards, it's like that's selama-lama dia lah. Alright, that means to say the bonds is issued. It's something like this. Shane, okay, he's so happy, and he lends me money, $1 million to fund a project. And this project is so long term, okay, so long term that I tell Shane that this project that I do, right, is gonna change the world. But you must give me time. I cannot give you a promise date that I'm gonna repay you.
Okay.
All right. But every time I didn't every day or every year I didn't repay you the money, right? You will get your 5% interest rate, your 5% interest income. All right. So you say, okay, lor. What sort of project is that? All right. Let's say you find it to be, wow, so world changing or something like that. Okay, lor. Then you give me the $1 million, and then as long as they didn't repay you the money, I have to give you the 5% forever. Until I say, Shane, I got the $1 million to give back to you. Then I give back to you. But if not, the interest income that Shane received is like forever. Got such a thing or not? Got. All right. This thing usually happens if it's not necessarily the company. Usually it is a government. Maybe the government want to do super long-term project, maybe a super long highway or railway or something, some sort of infrastructure that takes like 10, 20, 30 years to build, then maybe they can actually issue perpetual bonds.
Okay.
So the question is this. Just now Shane asked why issue bonds, right? So many other ways to actually receive financing, raise financing for your project. Why issue bonds? Good question. Now I'm going to answer that. So first, I'm going to compare bonds with bank borrowings. All right, you say, hey, but this bond thing is like, I borrow money from Shane, all right, and I'm paying him 5% interest. If let's say the bank offers 4%, wouldn't it be smarter to actually go and get the loan from the bank instead of getting from Shane? Actually, it depends. It depends on what is the bond that you are issuing. That's why I first introduced you to the 5 different type of bonds, all right, to actually so that I can explain these benefits better. Okay, now here's the thing. Bonds, bank borrowings. Okay, just imagine yourself. Bank borrowings is something like, let's say, for example, you going to the bank to get a mortgage from to buy your house. Okay, that's bank borrowings. Bonds is like just now what we see, the cash flow thing. So what are the benefits that is in favor of bonds? So let's say, for example, if you want to compare a fixed rate bond, remember, we have 100 ringgit, all right? He give me the 100 ringgit, I pay him 5% interest, right? So the good thing about this is that in this 3 years period, in the loan tenure, every year I just pay interest. And then at the end of the contract or the maturity of the bond, I only make the full loan repayment to Shane. But some bank borrowings may not be that way. Imagine, like, for example, you are getting a mortgage from the bank. First, you get the money to buy your house. Then every now and then, let's say the contract is like 20, 30 years, all right? You already have to start servicing the mortgage, right? That consists both principal and as well as interest. All right. So the difference between bonds and bank borrowings could be one just pay interest, the other one interest plus principal. All right. So maybe you pay a bit lesser if you use the bond way to actually finance your project. All right. That could be the first one. All right. The second one is that if let's say I'm the one who issue 0 coupon bonds. Shane actually lent me 850,000, like just now the example. I get the money, I go and finance the project. Okay. Until the end of the contract, I don't need to fork out a single cent to actually pay Shane. So let's say if the contract is 3 years, for 3 years I can finance my project without needing to worry about loan repayments to Shane. But bank borrowings are not that. Banks are not so generous lah. Huh?
Yeah.
Banks say, hey,
every month also need to pay the installment.
Every month also have to pay installment. So if you have zero coupon bonds, wow, your cash flow very nice because you don't need to actually think about debt repayments until the end of the bond contract. That's the second thing. The third one is convertible bonds. Even better. Let's say, for example, I don't have means to actually, let's say I still need after the bond contract ended, right? Let's say 3 years. Shane asked for money, all right? And let's say, for example, I feel that this money, right, could be better used to actually invest in another project. All right, if you have convertible bonds and say, hey, Shane, I'll be investing in this super duper project. Why don't you get my shares instead lah? Then in that case, right, Shane will actually be compensated with shares, and I still got the money to finance my next super duper project.
But I will only convert if I find value in your company.
Yes.
And your share price I think your company is undervalued, so it's good for me to convert right now.
Yes, of course.
So this is also one way that Warren Buffett likes. To invest in the company. I think Warren Buffett likes to lend money to you first. After that, if he see value in the end of the tenure, he will convert to become a shareholder. Then you no need to return my money. Let me be part of your partner in the business.
Yes, exactly. So that is why convertible bonds. But at least it allows me, the company, a chance to sell to you this super duper project so that you can become a shareholder. You can come in as a partner. Unlike banks only take shares if, let's say, they got no choice. Actually, they prefer money back. Yep. Perpetual bonds is even better because actually for bank borrowings, you think banks when they issue out, let's say, bank loans they always have loan tenure one. They always want to know when exactly they are going to come back, when exactly they're going to get back their capital. But if you issue perpetual bonds, no such issue. Because when you exactly repay the loan is not defined. All right, so maybe that's why some companies or corporations or governments may opt to actually issue bonds instead of bank borrowings. Now, what about shares? Okay, so here's the thing. A bond is actually a debt. It's like a loan contract between me, the company, the bond issuer, and him, the bond holder, the lender. Okay, he hasn't owned my company yet. I still retain my ownership. But if I do rights issue and private placement, like what you have just mentioned, then I have to cut off some of my shareholdings and give it to people like Shane, which is not something that I really want to see. So that's why I issue bond.
Okay. So you don't want me to take part in your business, but you only want my money. So you issue bond.
But I compensate you with interest you know.
Okay.
So that is why we issue bonds instead of shares. Then the second thing is that for me, right, because let's say I have full confidence in my project that it's going to make me super duper good returns, I don't want to share it with Shane. But since Shane is giving me the money, he's lending me the money, why don't I actually fix his return on investment? I say, Shane, this is the bond, all right, I issue to you, you give me money, I will give it back to you, but every year I will fix your interest income at 5%. Okay, so let's say, for example, the super duper project is going to give me a return on investment of 20% or 25%, and it really materialized. All right, Shane's interest income will still be 5% fixed. He will not take part in the 20% and 25% because he's not a shareholder. All right, so which means to say his income is capped, whereby my income is dependent on the project. If the project is super good, then my returns will be enhanced if I issue bond instead of shares. All right, the third one is holding period. Of course, this one I believe that For shares, right? Of course, if let's say I want to issue rights issue to Shane, of course Shane will have a say lah. That's the bad part about bonds, because Shane can actually hold the share, my company share, like forever lah. All right, so that is one thing good about share ownership over bonds. All right, so unless it's for bonds point of view, unless it's a perpetual bond, otherwise the thing is actually quite fixed. The loan tenure is quite fixed. Actually, it can work both ways. All right, it depends on the intention. Number one is that if let's say I'm a company and I want Shane's money forever, then of course I'll issue shares. But if let's say I don't want to hold on to shares, I don't want to hold on to Shane's money like forever, so I just give him a bond so that I can fix. Okay, Shane's involvement in my company, right, as a bondholder is only like 3 years. After 3 years, I take his money, I give it back to him, and have nothing to do with him already. So that's the beauty of the bond side. Of course, if let's say my company, right, if I give shares to him, what if my company doubles in value?
Then you may not feel emotionally not so right.
Yes, yeah, of course lah, because everyone is greedy in that sense lah. But then of course the only thing is that the difference between bond and shares is this lah. But when I cap Shane's involvement in my company financially and fix his interest income, I have to give him some guarantee lah why he should actually subscribe to my bonds, which is if my company doesn't work out, let's say my company go bankrupt, then of course he will get first priority over my assets, over shareholders.
Preference shares holder and also the common shareholder.
Yes. So that is the difference between bonds and shares lah.
Okay. So when a company need a cash call, I mean they needs money, so they need to decide whether should they do a rights issue, should they do a private placement, or should they borrow money from the bank, or should they issue bonds?
Yes.
So they will weigh, okay, what would be the more effective way or best way in this case where they want to undertake a certain project or certain investment.
Correct. And of course, with that, we are going to look into Sukuk.
Yeah. So what is Sukuk?
Good idea, Sukuk. All right. I have actually done a little bit of research on it. So let's take a look at what I have gathered. All right. Because to me, as a non-Muslim, to me, bond and Sukuk more or less the same lah. All right.
But of course, Sukuk is very new to me as well.
All right. Because I think only maybe most of the Muslim community may be more interested in Sukuk. But for us non-Muslim, we just say, more or less the same, right? What's the difference? But actually, there are some form of differences between the two. All right, so it's good that all of us as Malaysians know what Sukuk is.
That's why I want to applaud you for coming to this webinar today to learn what exactly are Sukuks.
Okay, Sukuk is something like this, because under Islamic finance, okay, what I've studied, because I'm not Muslim, so what I've studied, at least from the internet, is this: for Muslims, right, it is actually not permissible for people like you to earn interest.
I'm a Muslim.
Yeah,
I can't earn interest.
Let's say Shane has converted. now he's Muslim. Now let's call him Muhammad Shane. Muhammad Shane. So I can say, hey, Muhammad Shane, I issue bond to you lah. You earn the interest income. He say, then Shane say, tak boleh lah. Saya sudah convert jadi Muslim. Alright, how? Are you like that lah? But then I still want your money. I still want to pay you the fixed interest, but I cannot issue bond to you. How? That's where Sukuk comes in. Alright. So Sukuk, actually the intention is pretty much the same. I'm the company, I want to raise funds for my project. So instead of using bonds, because bond involves riba, which is not permissible under the Islamic or the Sharia principle. So I use Sukuk. Alright, so I say, okay, don't worry, I got Sukuk financing. Let's say, apa itu Sukuk? Okay, so Sukuk is like this. I'm going to tell you a project. Okay, so I tell you, Muhammad Shane, this is the project. This is the project that I'm doing. Oh, you look at the project. Okay, so the Sukuk, all right, I'm going to give you the Sukuk. It's a contract that evidence that you will be the owner of this, you will be a part owner of this project or the company's assets. or the stuff that I'm undertaking. Okay, so let's say you're interested, you are going to receive a contract, and you're actually a part owner of that asset. Okay, but so now you're the part owner, right? But I'm the one who's managing and running the business, the whole show. So what you do is that you actually lease it back to me. Okay, you lease it back to me, so it's like I'm renting from you. Okay, and when I rent it from you, I have to pay rental income to you. All right, so that is where your periodic profits come in.
And it's profit,
yeah.
It's not a rental. It's not a rental, it's a profit.
It's a it's.
So if the company don't make money, how? Don't make profit, how?
I still have to pay you I still have to pay the rent lah.
You still have to pay the rent even though the project did not yield any profit.
Yes, because I'm like renting the thing. I'm renting the thing from you,
Okay.
Yeah. Okay.
Okay.
So now you're getting okay lah. So now from your point of view, you own a certificate that evidence the ownership, that you are the part owner of that company's asset. You are actually in a way macam lease it back to me so that I can run the business on behalf of you. Okay, and on a periodic basis, maybe setiap bulan or setiap suku or something like that, I have to give you a periodic profit, something like your rental income lah, and give it to you because you're the owner I'm the like tenant right? And after the maturity of the contract, I will have the right to actually say, okay, I want to buy back the company's asset.
Give me back my money.
I want to buy back the company's asset and the projecting from you. So then you say, okay, look, then you ask, where's my money? Then I give you back your money, and then I will be returned my ownership of the project or the asset. So far clear, right? And of course, by the way, for those of you who are more familiar with Sukuk, and if you're Muslim, if there's anything that I may explain wrongly, so apologize for that lah. So that's at least our findings lah. All right. It'll be great to actually learn more about these things, but that's my understanding thus far.
So whether the project makes money or not, as a Sukuk holder, I will still receive the profit.
Yes. All right. And with that is why Sukuk is Sharia compliant, not bonds. Okay. Now, so what's the difference between bonds and Sukuk? So number one is the ownership. Okay, like bonds, you totally don't own my company's asset or my project, but for Sukuk, you are part owner of that asset. All right, that's the difference. Number one. Number two, you will receive profit sharing from the underlying asset. All right. Whereas for bonds, you earn the interest rate or the interest income or the coupon from the bond. Okay, so in a way, how bonds are valued is depending on my credit rating. All right. Whereas for Sukuk, the value of the Sukuk is actually based on the company's project or the company's asset. That's the third difference. And of course, the fourth difference is obviously why there is a difference between bonds and Sukuk is simply because bonds is bounded by, let's say, the locality of the local laws, the business laws and stuff like that. But Sukuk, you must be Sharia compliant, which means to say, let's say for example, hey Muhammad Shane, I got this project I want to do. I want to open infrastructure. What kind of infrastructure? I want to open casino at some pulau. Then you cannot do lah, because it's not Sharia compliant. You cannot use Sukuk to say, I want to open one gaming center at some pulau. No, it doesn't work.
So the activity that the company wants to undertake has to be Sharia compliant to be able to issue a Sukuk.
Exactly. It must be Sharia compliant and it must be permissible under the Islamic principles, right? So how do we calculate the yield of a bond? Good question. Now let's take a look. So just now we have studied bonds, we have done Sukuk. Now we are talking about exchange traded. So why there's these two words, exchange traded? Because like what Shane had just explained,
it can be traded on the stock exchange.
Yes, it can be traded on the stock exchange. So why does it have to be traded on the stock exchange? Because there are a few ways to actually buy bonds. Number one is from over the counter.
Buy through the banks.
Yes, but that one you need a lot of money lah. All right, and unfortunately for us, we really want to make some of that kind of friends lah. You know, the ones that have $3 million in the bank, the ones that can afford to actually buy bonds directly from the bank, right? Yeah, unfortunately we are retail investors, have smaller capital, so no lah, we cannot do that. then
we can go to Fund Supermart and buy.
Fund Supermart is actually the big guy. He buys the bond on behalf of he buys the bonds. All right, so let's say for example they have a bond, they have the money, so they buy the bond, and when they have the bond, then they sell it to smaller people like us lah.
So we buy a unit of the bond in a bond fund.
Yes. So
that's how retail investors usually participate in the bond market.
Now only got lah. Last time it doesn't have. Now I believe they just launched these things.
Oh, okay.
So yes, that's why their tagline is everybody can buy bond.
Okay. But now there is third way, which is exchange traded bonds, where each one of us can participate in bond market on the stock exchange.
Yes, directly from Bursa Malaysia.
Not on a bond exchange, but on the stock exchange. Okay.
Yes, exactly. So how to calculate yield? So we have two types. The first one is we calculate the current yield. All right. The second one is yield to maturity. Okay. So I'm going to explain these two really quickly, and let's take a look. Very familiar kind of example. Shane lent me $100. All right. And the coupon rate is 5%, maturity 3 years. So in this case, the yield is very simple. It is $5. All right. If you want to calculate his current yield for, let's say, year one, it'll be like 5% or 5 ringgit. Divide by the amount of lending he actually give it to me, which is $100. 5 divided by 100 times 100%, so it's 5%. So that is your current
Very
yield.
straightforward.
Very straightforward. So now, if let's say the same bond is to be listed on Bursa Malaysia, okay? Let's say like scenario 1, all right? The same bond, and let's say it's actually listed on Bursa Malaysia, so you can actually buy and sell whenever you like.
Because when there's market forces, there will be some bonds that are selling at premium, there will be some bonds that are selling at discount.
So let's say, for example, right now, right? Let's say another guy, he can come in after the bond is listed on, let's say, Bursa Malaysia. At year 1 itself, you can buy the bond for 95 ringgit. Okay, that means say you can actually, if let's say this is Shane or Shane number 2, instead of giving me $100, he's now giving me $95, and he still received the $5 interest.
So the yield definitely go up because my principal investment go down.
Yes, and this is how you calculate your current yield, which is as followed. So you see the table, okay, so this is the cash flow table that I prepared for you. So let's say at year 1 you paid $95. All right, okay, year 1 obviously you won't get any interest, so you start getting the interest at year number 2 because it's after 12 months, and you get $5. So therefore, if you take 5 divided by 95 times 100%, therefore your current yield is 5.26%. All right, so that's your current yield. But actually, that is not your total return, because at the end of the bond, right, the contract thing, right, instead of getting back $95, you're going to get back $100. All right, so that means to say at the end of the maturity, you are going to receive a little bit more. So it's not $100 you lend it to me, $100 I give it back to you. It's 95 to me,
I take back 100.
You take back 100. So therefore, there is such a thing called yield to maturity, and the formula is as followed, which is the amount that you collected back minus off the amount of money that you have lended to me. So it's $5, right? But then that $5 is actually being earned over a period of 2 years, because you only buy the bond at year number 1. It ends at year number 3. So you have to divide it by 2. All right. So therefore, you still get 2.5% extra lah from your 5.26% current yield. So therefore, if you take 5.26 plus 2.5, your yield to maturity is 7.76% as shown on the table. Now, let's look at another scenario. Scenario 2. Let's say, for example, you buy the bond instead of year number 1. Now you buy it at year number 2. So you buy it 1 year before it expires. So what would your returns be? Your current yield will be, as you can see, the cash outflow starts at year number 2. You paid $95. At year number 3, you get the $5 in interest income. So your current yield is still the same, which is 5 divided by 95 times 100%, which is 5.26. But your maturity, you see, because it's 1 year only, you pay me 95 at year 2. 1 year later, I give you 100 already. So which means you are going to get more or less 5%. All right, 100 minus 95 divided by 1. So it's 5%. So therefore, your yield to maturity is 10.26%. All right. So that means to say, in year 2, your yield to maturity will be much higher than a person who buys the bond at year 1, although it's at the same price. Okay. Now let's look at a reverse scenario, which is scenario number 3. Let's say you can buy the same bond, all right, but instead of $95, now this time it's reverse. Shane say, Ian, okay lah, like this, I borrow you, I lend you 105. I still collect my 5% interest, all right. And at the end of the loan contract or the bond tenure, I get $100 back. So what would your current yield and your yield to maturity be? So let's take a look. So let's say in year 1 you pay 105. Year 2 you get $5. All right. So actually, right, you take 5 divided by 105 times 100%. Your actual current yield, right, is actually 4.67%.
Because I invested the bond at a premium price.
Correct. And at the end of the maturity, you get back $100. All right. So that means you lose about $5 in principal over a period of 2 years. So therefore, you have to minus off 2.5% from your current yield, and therefore your yield to maturity is around 2.26. Okay, which is a bit lower than if you buy it at 95. So that is the thing here. When bond prices are low, of course, your yield to maturity and your current yield will be much higher. If you buy it at a higher price, then of course your yield to maturity and your current yield will be much lower. It is the same for scenario 4. If you buy the same bond at 105 at year number 2, so what will happen? So if you paid 105 in year 2 and you only get your cash inflow at year number 3, all right, so as you can see, you get your $5 in interest. Your current yield is 4.76 as per usual. Sorry about the typo. It's supposed to be 5/105. Yeah. Now, when it comes to your maturity at year 3, your cash inflow is $100. So that means you will lose 5% from there. So therefore, your yield to maturity it's 4.76 minus of 5. Therefore, it is 0.26%.
Interesting, but essentially in this scenario, right, I buy 105, I take back $5 in interest, and then I take back 100. So essentially, I don't lose any money.
Essentially, you lose on inflation.
Yeah, I lose on inflation.
Okay, so now I'm going to give you some case study, all right, so that you can actually be familiarized with the calculation. Okay. So this is actually we're going to do one exchange traded.
Now, because why does this use very important? Why is this use important? Because when you invest in bond, generally, we would not expect so high capital appreciation. It's mainly from the income perspective. Do you agree?
Yes.
And that's why learning how to calculate the yield is very critical as to be a bond investor. If you look at America, the treasury market, you see that their yield is actually going down. In other words, their bond price is going so much higher. People are willing to pay the bond at premium rate to receive so little yield. So that means how fearful is the market.
Yeah, of course.
Yeah, at a certain point there are also inverted yield, okay, that took place. So that's why when it comes to bond investing, it is important that we learn how to calculate yield. And so glad that today we have Ian to share with us how to calculate yield. And we're going to do a case study on one of the issuer, which is Dana Infra National Berhad.
Yeah, of course. Yeah. So Dana Infra, actually in Bursa Malaysia, there are four. There are four ETSB, exchange traded bond and Sukuk, listed on Bursa Malaysia. And three of them are from Dana Infra National Berhad. Okay. So basically, these are the four ETBS, exchange traded bonds and Sukuk, listed in Malaysia, on Bursa Malaysia.
So mainly all four are Sukuk, huh?
Yeah, basically all four are Sukuk lah.
Sharia compliant.
All Sharia compliant. Okay. And the first three are raised for the same purpose lah. And the project involved is actually the Klang Valley Mass Rapid Transit, the KVMRT. Okay, the KVMRT project. That is why they actually have this Sukuk. So if you buy this, then who knows, you are part owner of the MRT project.
Oh yes, yeah, because they lease back from you. Right?
Yes, exactly.
Okay. All right. So the other one is the last one, the Isan Sukuk.
The Isan Sukuk, I have no idea what that is, but anyway, the top three is actually for the same project, so that's why I study that.
So there are actually four listed exchange traded bonds and Sukuk on Bursa Malaysia that every retail investor can participate.
Yes.
Yeah. So these are the stock code I remember. Yeah.
Okay, so let's talk about this particular Sukuk, all right? So the purpose of the Sukuk, all right, why they have this Sukuk financing is because they want to fund capital expenditure and operating expenditure of the Klang Valley Mass Rapid Transit project, all right? So this Sukuk was first listed on 8th of February 2013, maturity date 8 February 2023, which means it's a 10 years horizon.
Years, good. Yeah.
Par value $100 per lot. Every lot, okay, by the way, minimum subscription is 10 lots, meaning to say if you want to participate in this, at least your initial investment capital will be around 1,000 plus lah, or more or less around there lah. So that is your more or less there lah. Okay. Profit rate, they agree to pay you 4% in 4% per annum of the par value. So which means to say every year you're gonna get 4%, all right, or $4 for every $100 in par value. Payment frequency, semi-annual, which means every 6 months they will give you $2. More or less there lah, all right. Every 6 months, 2 ringgit. 6 months later, 2 ringgit, and so that means there will be like 20 payments of 2 ringgit lah. Okay. Yeah. And the redemption is 100% of par value at its maturity. Means to say, for every lot they will give you back 100 ringgit, depending on how many lots you have lah. So these are the key details of the Sukuk. And right now, because it started at 8 February 2013, all right. Now, to simplify this particular webinar, let's assume that we are now at year number 7. Wawasan dua-puluh. Okay. So this is the price that we can get into right now. All right, which is $100.60.
So this is the current price, the last you check.
Yes, or at least when I do this.
So slightly above the par value, 60 cents above the par value.
60 cents above the par value. Actually, the price didn't go anywhere lah.
So that means your annual yield will not be 4%, but maybe 3.9 something percent.
Correct. Okay. And therefore, what is your returns, right? So this is where we calculate your yield. So let's assume that in 2020 you paid 100 ringgit and 60 cents for per lot of this bond or this ETBS. Your cash inflow is still $4. So therefore, if you take 4 divided by 100.6 times 100%, your returns will be, your current yield will be 3.98%. Yeah. Okay. And this bond, or sorry, this Sukuk will mature in 2023. So by 2023, you'll be redeemed you can collect back $100 from Dana Infra. So meaning to say, you paid 160 cents, you collect back 100 ringgit
per lot.
So you will lose that 60 cents lah, essentially. So that 60 cents, if you divide it by 3, then of course you're gonna, of course you will lose like 0.2%. So therefore, if you take 3.98, your current yield minus off the yield to maturity, which is 0.2, your yield to maturity is 3.78% lah, or 3.8% like that. Okay, so it's a little bit better than your FD lah, so to speak. Okay, so with that, I have ended my session.
Oh,
And
okay.
Yeah, actually, what time is it now?
Yeah, still have more time for question and answer. But let's talk about bond versus fixed deposit.
Okay.
Okay, now, am I right to point out that bond and Sukuk are slightly more risky than fixed deposit because they involve debt lending?
In a way, yes.
Yeah.
Okay. Number one, because fixed deposit in Malaysia, if let's say you didn't put like more than $250,000, then of course it's PIDM insured.
Okay.
Right?
But bond have a slightly higher risk that the company may not be able to pay you back the principal sum.
Yes.
Right. But of course, with higher risk instrument, it comes with a higher return because if you look at our fixed deposit, maybe 3%. But in this case, the Dana Infra is able to offer you 4% yield a year. If you are willing to take slightly more risk.
Yeah, that's the only thing lah.
Yeah, so it all depends on us whether our risk appetite. Okay, how are we going to diversify our portfolio? So if you already have a lot of equities in the portfolio, and maybe it's time for you to move some into the debt capital market, which is the bond, or maybe keep some in the FD. Okay, so now let's just do some question.
Okay, let's do some Q&A.
So the first question, so if you have any question, please write in the question box so Ian will be able to see and answer them. Okay. So number one, what if zero coupon bonds, if the company goes bankrupt, what happened to the bond?
Good question. All right. So when a company goes bust, right? All right, the company will have, let's say, they have to lelong some assets. They have to auction some assets.
Go through the liquidation process.
They have to go through the liquidation process, and let's see what they can recover from it. So let's say, for example, for the company, right? Let's say they recover certain portion of assets. Then of course, compared to its shareholders, bondholders will get the first cut lah. Let me say, at least the bondholders will actually get paid from whatever is being liquefied.
Okay.
First over the rest of
shares.
Yeah.
What happened to other like borrowings from the bank? Will the bankers have the first say before the bond?
That one you have to look at who you have to actually have a list of priorities like who is actually in the top priority. So that one you have to, even banks also, it depends on what is the loan structure of the bank. Some can be secured loan, some can be unsecured loan. Then here we go lah. Then there's more ranking to be ascertained before they make the payment to the respective stakeholders.
So the next question is, what is the major risk in exchange traded bond and Sukuk, and how do we mitigate the credit or business risk if the company can't perform the projects in Sukuk?
Good question. All right, basically, if you want to invest, first of all, you must actually have a sense of belief that the project can work. Then of course you will lend the money. So it is very important for you to know what is the purpose of the company or the government. Why do they want to come up with this Sukuk financing or bond financing before and then they will market this to the people. So if you are an interested party, that means that you want to buy and participate, so make sure you first know the project. Okay. Second thing is that after you have purchased this thing, right, there's no sort of how would I say, downside protection or whatsoever lah, because it's a loan contract, and it depends on what is being stipulated in the loan contract. So the best way to do this is, of course, exercise this thing lah, which is don't put all your money into one basket. All right, you may actually spread out your capital across different stocks or different securities, so that if one got bombed, then you don't get. If one of these stocks got bombed, then it doesn't hurt your portfolio that much lah. That's what I'm saying.
Okay. So the next question is, can the bondholder request for capital back in any year in the case of perpetual bond?
Well, actually, the first thing is the reason why it says perpetual bond, right? Is simply because they want your capital like hold your capital like forever lah.
So can't take back the money lah.
No
Can't
lah.
take back the principal lah.
That's why make sure you read what's the underlying contract before you actually get into it lah.
The next question is, what is the net asset value of a bond and what affects it?
Net asset value of a bond. Okay. It actually, a bond, right, is a lending thing. So lending thing means there's credit. All right. So when we talk about bond, we want to talk about the credit worthiness of the issuer. All right. Let's say Shane is the lender, I'm the borrower, I'm the company. So before Shane actually gives me his money, he wants to know whether I'm trustworthy or not lah, in terms of my credit. Okay. So if let's say I am deemed to be very good, very trustworthy, all right, my credit score is very nice, then of course people are more than happy to lend money to me lah. All right, and that is the thing that affects a bond lah. But if let's say my credit score is not so good, then of course Shane may be reluctant to actually give me the money. Or if he is willing to help me out, if he is willing to give me his capital to me, he may ask for higher return, because he may say, hey Ian, your credit score not so nice. I don't think there will be anyone apart from me who will be lending money to you. So with that, right, but then I lend money to you because I support you. But then I support you, I must get better returns. So for me, I'm a bit desperate. I said, okay lah, I think Shane is the only guy in the whole wide world that will give me the money. So therefore, I will increase his interest income. So instead of a conventional of 5%, maybe I will up my interest income to, let's say, 7 or 8%, so that I can actually compensate Shane for taking a risk, taking a chance in me. So what affects a bond is actually the credit worthiness of the issuer.
Okay, so how do we select good bond to invest? That is the next question.
Credit worthiness.
That's what you say. But usually all these high credit rating, like AAA bonds, or for those bonds that are very good rating, the yield is not so high.
Yes.
Yeah, so high yield bonds are the one that the risk is a bit higher. So it all depends on your risk appetite lah. Okay, if you can take a bit more risk, you can go for high yield bonds. If you are more conservative, then go for investment grade bonds.
You can mix and play lah, depending on your preference.
But anyway, today let's focus on the exchange traded bonds, okay? Because under Bursa Malaysia. Okay, so generally speaking, next question is there a particular type of bond that delivers the highest returns? This is assuming risk and other factors remain equal across different bond types.
Junk bond. Okay. Obviously, it's partially joking, but it's also partially truth. The ones that give the highest returns are usually the ones that people don't want to actually lend money to, right? So that's where your junk bond comes in lah. Why is it called junk bond? Because people treat the bond like junk lah, because people don't want to lend money into it. So that's why it's called junk bond.
Yeah, I remember when the country Greece went bankrupt several years back, I read that their bond yield is at 16% a year. So this is the kind of rate that a sovereign bond can fetch. Okay, actually I don't know what is the 100DB bond yields right now.
Actually, it's like, of course you can look at it from a country's perspective. Like say for example Germany. All right, Germany, obviously the bond rate the bond yield is going to be super low because their credit rating is super strong. All right, of course, Singapore is going to have very good credit rating, and Germany and the US. Of course, these countries, while their credit rating is so strong because their financial records are much better. I'm not too sure about US, but let's say Germany, I have more faith in them. So, okay, let's say they are pretty good. So, of course, the bond yields will be obviously lower because their credit rating is actually pretty good. But if you're talking about other countries, let's hope Malaysia holds up. If Malaysia holds up, then maybe our bond yield is not too high. Right? But if let's say something happened to our country's finances, then of course that's not so good to our credit rating. Then of course people will want higher returns for their money before lending the money to us.
Okay. So the next question is there any bond ETF in Malaysia?
Bond ETF, there's only one that I know of. All right, there's only one. I do not. The name starts with an A. It's ABF something. All right.
Yeah, there is. Okay, let's go and find out Bursa Malaysia. Okay. So the next question is, how can one sell a bond before it matures through Bursa Malaysia?
Just go to your online trading account and just make the trade. All right. Like for example, right now you can buy. Okay, if you see, let's say you go back, right? So right now it's this is a 10-year Sukuk, so you can actually buy it right now. Let's say the price is about $100.70 or $100.60. Then of course you can go to the market straight away, open your stock trading account, and you can make the purchase online, and then you will own a Sukuk. And then if you want to dispose it, then you will dispose it and get back your capital.
Yeah. So this is already on the secondary market. We can trade bond on the secondary market.
Correct.
Yeah. So next is can exchange traded bonds and Sukuk holder attend AGM?
I don't think so. I'm not too sure whether they have AGMs or not. That is actually a little bit beyond my knowledge. All right.
Okay.
But if let's say it's a bond, then of course there's no AGM for you to attend.
Okay. Because I personally have not invested in any ETBS before, so I've got no experience as well.
Yeah.
Okay. So
so do I. So
all right. So the next question is there an X date for bonds stock for interest entitlement similar like dividend entitlement for a stock?
That one I believe yes. That one yes, you can go to Bursa Malaysia website and they will tell you when exactly they're gonna credit the interest or the profit rate to you. All right, they will give you a lot. They will give you some information like for example how much they are going to declare, when exactly is their payment date, and stuff like that. So you just need to go to Bursa Malaysia. What you can do is this. Let's say for example, let's try out this. If you are watching this webinar right now, let's say you can go to Bursa Malaysia website. All right, and then at the stock code at that part, right, you just type in 0400GA. All right, that's the stock code for Dana Infra National Berhad, kind of ETBS. You click onto that, you click onto company announcement, and I'm sure you can actually get all this information. Very handy. So the answer is yes.
Yeah. So the next question is, if the bondholder sells it before the X date or maturity date, will he or she still get any interest upon the bond maturity date?
Yes. All right. So that's why when it comes to bonds, right, it's not like FD whereby, let's say you have a 1-year FD, you hold it for 9 months and then, I need the money, I need to cash it out. Then you lose the interest. That's FD. But for bonds, it's a bit different. That's why they have two types. For bonds, they have two types of pricing: the clean price, and as well as the dirty price. So what do I mean? Okay, for example, okay, I purposely make this slide close right at the dot at 2020. All right, so if you want to be super exact, let's say the bond is actually listed at on 8th of February 2013. So this should actually represent the period whereby you bought it at 8 February 2020. But right now, as we speak, we are now at November 14, 2019. Okay, so it is still 3 months away, right? So I believe you're going to get a little bit more than when it comes to if it's let's say actual bonds all right, you're going to get the accrued interest, or at least you're gonna pay a price to compensate the existing bond holders. That means, let's say I'm the buyer, he's the interested seller, he has already hold the bond for quite some time already. He won't lose his interest. In fact, when I buy the bond, I have to buy and pay your interest so that you don't lose the 3 months. All right. So there's such a thing called clean pricing and dirty pricing for bonds.
Now, for this example, what is the minimum amount to purchase 0400GA? Like the quoted price now is 160 cents. Is it one lot 100 times 100, which means 10,060 ringgit?
No, you see, like per lot. Okay, so the price is now $100.60. Minimum lot is 10 lots.
So one time I need to buy 10 lots. So times 10, not times 100.
No, so it's like 1,000 ringgit just to start investing.
Okay, can we request to get an annual report from the bond issuer?
You can check out
ETBS issuer, what the question means.
Usually they won't. You can try, but it's not actually given on Bursa Malaysia website.
Do the bond issuer need to have something guaranteed or mortgage to issue a bond?
Bond issuer. Okay, first they must actually, like for example, for a Sukuk, they need, all right, the Sukuk, they need to actually they need to define the purpose and the underlying asset of the project. So for Sukuk, yes, you need that.
Okay.
For bonds, it depends on what is the purpose and how they structure the bond. Sometimes they may issue bonds, right, not for any sort of projects or what. It's just they can actually, let's say for example, I'm the company, I want to issue bonds to Shane, maybe because I want the capital and I want to put it in the bank account. All right, just to hold it for reserve or something like that. Then there's no underlying asset or no underlying collateral, so to speak. So in that case, you don't need. But for Sukuk, you need to show something, because what the Sukuk buyers are actually getting into is they are funding a certain company or they are funding a certain project. So you need to actually show a certain kind of asset, because what Sukuk people are buying is actually the asset.
Okay. The next question is, what are the risks involved in investing in bonds?
Number one, if you get because this is lending one, so when you lend people money, of course some people may not pay back. That is the risk. So which means to say that there could be possibilities of loan defaults. All right, so when that happens, then that is very bad for the bond. All right, because it loses creditworthiness, which means to say bonds and creditworthiness are they are two words intertwined. All right, bond value is dependent on creditworthiness. If the bond loses its creditworthiness, then of course it will be very bad for the bond,
because the company have to service more in terms of interest.
It's just like how people and bank like that all right, if people are creditworthy, then of course maybe the bank will love you because they want you as their customer because you're creditworthy. If let's say the bank sees your credit profile and say, oh, your credit score like that one, then of course the bank doesn't want you to be your customer. All right, because you're not deemed to be creditworthy enough for them to lend money to you. They don't trust you enough they don't trust you enough in terms of repaying the loan on time and stuff like that. Then of course they won't.
Okay. So what could be the factors that cause the bond price to be lower than the par value?
Bond price to be lower than the par value.
Yeah, than the issue price.
It could be possibly the bond may lose a little bit of creditworthiness, so maybe that's why the bond price may be a bit lower, or they can be a little bit depressed. All right, so that may actually causes that could be the first reason why the bond price may be a bit low. The second reason, it can be nothing to do with bonds. You see, like for example, bonds are it's all willing buyer, willing seller, right? So let's say in a good market, all right, you have more investors lah, who are actually more how would I say,
They are more risk taking.
they are more aggressive.
So they, instead of bonds, they want to go for risky asset. That's why they sell down their bonds holdings to rebalance into a more equity heavy portfolio.
Something like that. Then that causes the bond price to go down.
Yeah, because whatever is traded on the exchange is subject to the forces in the market, the
Correct.
supply and demand. So when you see that the current traded price lowered than the par value, it means that the yield will go higher, and it means that people are now willing to take more risk to go to a higher risk assets.
Yes, exactly.
Okay. So the next question is, why are the bond investment less attractive to retail investor in Malaysia?
Well, it depends. Number one, there are more shares listed on the stock exchange over bonds. That's number one. All right. Number two, you see there are a lot of people participating in the stock market. They may not be investors. There are many different types of people who are involved in buying and selling shares in the stock market. Not all of them are investors. So that's why the subject of investing is so confusing. All right, because you have different types of people, with different types of objectives and personalities involved in the buying and selling of shares in the stock exchange. All right. So for instance, we have investors, number one. Okay, investors are people who actually, they are pretty much conservative. All right, so they are conservative people who just want to buy into good companies and make sure that the good company shares are offered at a discount, and they just want to enjoy some good form of recurring dividend income. Something people like me lah, for example, dividend investor is actually one type of investor. But there are also other people who like something more exciting. All right, they are into trial out. They do not have a specific plan, or they do not have an investment plan. They do not know what they are doing, so they just come in with money and they just want to try their luck. So basically, these are people who believe that they can double or nothing their money in the stock market, and they can go in at $1, come out with $2 at the shortest possible amount of time. It's so exciting, so they go in. There are also people like that in the stock market. And of course, there are traders in the stock market who uses sophisticated advanced trading tools, charting tools, to actually time their market, where their mentality will be very different from how investors would adopt when it comes to buying and selling shares. So you have different people with different backgrounds, with different amount of capitals, with different personalities, and as well as different characteristics in the stock market. So therefore, that's why maybe share market or the stock market, right, may cater to all these people better, so much better than the bond market lah. So maybe that's why more people are into shares than bonds lah.
Yeah. All right. So the next question is, what is your view on buying bonds from some other platforms such as fundsupermart.com? Is liquidity better than the exchange traded bonds and Sukuk market?
More or less the same, I suppose. Okay, so it depends what gives you the better deal lah. All right, you can, of course, because Bursa Malaysia we have 4. All right, of course, if you go to Fund Supermart, obviously you are gonna have a lot more choices lah. All right, you just go to 2 websites and you compare lah. So the whole idea is that anything that gives you the better deal, right, you can just go for it directly lah.
Okay. Is there any correlation between the the Malaysian equity market and the Malaysian bond market?
Correlation. All right.
Do you study into such depth?
Of course not lah. But then what I know is this lah. Let's say for example, if I'm a company, let's say I'm the company, okay, and if you want to logic it this way, right? All right, I'm the company. I'm trying to invest in the business. I'm actually running a business, and I will get a profit, right? So let's say for example, of course, the lesser interest rate I pay to people, to my borrowers, let's say people like Shane, the more profits I'm going to generate. So if Shane is getting a fixed interest income, all right, and my profits go up, of course, my share price will also go up, all right. But if let's say Shane or any other borrowers are getting more interest income from me and I get lesser profits, then of course, the bond market will do much better than the share market lah. All right, so that's my general understanding, my general logic lah. Maybe Shane, you can actually add to this particular question. What do you think lah?
Okay, then let's go to the next question. Is there any market maker for the exchange traded bond and Sukuk to avoid liquidity issue?
Market maker. I thought Bursa Malaysia is the market maker, right?
Or no, Bursa Malaysia is the platform.
This one
to provide a place for the issuer to issue the ETBS on the stock exchange.
So far no comments on this issue lah.
Okay, yeah, no idea.
No idea lah.
Yeah, okay. I also have no idea. Okay, I never bought any ETBS before because I'm more like a stock guy. I'm not a bond guy. Okay? But you're more conservative, so I don't know whether you bought before or not. Okay. Now, for the bond listed on Bursa Malaysia, after the interest X date, will the bond price be adjusted? Like what happened to dividend?
Slightly lah. In the case of Dana Infra, not much lah. That's why you can see the stock price also doesn't go anywhere lah. So,
okay.
It's there to give you fixed periodic profits every 6 months once.
Okay. Wait, so what is the difference between a bond and the P2P financing?
Oh, that's a good question. Okay. Now, P2P financing, all right, and bond, number one, of course, the return is actually a bit different lah. All right, that's number one. Of course, people are expecting to get more from P2P financing. So if you're into that kind of returns, then of course, P2P will be preferred over bonds. That's number one. Number two, when it comes to bonds, right, usually people who issue bonds, these are actually bigger companies or government. All right, so which means to say if you want to actually get bonds or Sukuk from bigger companies or more established companies or even the government, right, then you may actually go into ETBS. All right, because people who actually go into P2P financing, they are all small and medium enterprises. All right, the reason why they go into P2P is simply because if they want to go through bank loan, they have a lot of paperwork to fill out, and they have a lot of rules and restrictions that the bank may impose. When it comes to financing. All right, when it comes to financing for the SMEs. All right, but if they go through P2P, then maybe SMEs have a much easier time to actually get financing lah. All right. Now the third one is when it comes to default lah. So if let's say I'm the issuer, I'm the bond, and then I default, then of course maybe as a bondholder you get back something lah, you can recover something. But when it comes to P2P, when let's say the company default or something like that, then a bit hard for you to actually get back anything lah from your investment. That's why if you want to go into P2P, of course this one I have a friend, actually we have a mutual friend who actually went into P2P.
We have a mutual friend?
Yes, of course, our Taiko KC lah. So he went into P2P.
Oh, okay.
Yeah, so it's actually based on his experience.
Okay.
Because what he did was P2P, right? He put in, let's say $10,000, and then he diversified. Every single lender, every single SME, he put $1,000. Okay, so we have 10 P2P P2P lenders, P2P borrowers, sorry, 10 companies, these are borrowers, and he's the financier. Every single one, let's say, every single one of them, let's say they are making 10% in interest rate. So the first one, okay, they pay back the $1,000 and you pay the 10% interest rate. So you get back 1,100. The second one did the same. The third one did the same. For the first 9 borrowers, everyone pays him back the 10% interest. So you get back 9,900. The last one, after paying for, let's say, 2 months, let's say the financing is for 1 year, after paying for 2 months, the company actually defaulted. And the 2 months, let's say you get back $170. Okay, so it's 9,900 plus 170, which is about $10,000. And then the amount defaulted is actually principal and interest default. You lose everything. So you can have one default that wipes out your.
Yeah, but essentially, our friend Casey still makes money lah. Don't lose money, just don't make as much lah.
Yes.
Just he takes back 10,000 plus lah.
So the strategy is don't go with too much capital in for one SME. That's why a lot of people when they do P2P, right, they only go like a few $100s per company. But of course that is just outside the topic. So what I mean to say is that if you want better, more let's say the quality of the borrowers, the credit worthiness of the borrowers is much stronger, then just go with ETBS.
Okay, yeah. Okay, the next question is, which one has more priority when it comes to liquidation? Is it bond or Sukuk? You don't know, is it?
I have no idea, but
Okay,
based on
I have no idea.
But based on Sukuk, all right, because this ETBS, right, this Sukuk is from Dana Infra lah, so it's government, right? Can government go default? Like Malaysia went. Let's hope that they won't happen lah. Okay.
Next question is the bond value, ETBS value, affected by the bull and bear trend? Market force lah.
Less likely. Less likely than stocks.
Okay. Okay. Let me see. So the next question is, can we subscribe to the bond like we subscribe to the IPO share? Possible?
Possible if it happens.
Okay, that means how but of course on ETBS you can't because all these are exchange traders, so you have to trade on the stock exchange. You want to subscribe to the bond, I think you got to go to the primary market, like subscribe from the banks.
Okay.
All right, I think we have done enough in all the technical terms. Okay, I hope that you are not bored by all the technical terms that we covered, and hope that you can get as much as you can from this ETBS webinar.
Yes.
So now let's talk about when is our next webinar. Next webinar will happen on the 3rd of December. This is the last beginner webinar for the year of 2019. So we are going to do how to invest rationally in an irrational market. So the registration link is already shared on our chat group. Please go to click immediately if you want to learn from our speaker, Pauline Yong, on how to invest rationally in an irrational market. All right. So yeah, with that, thank you so much, Ian, for spending your time with us this evening to talk about ETBS. I know that it is not an easy topic because that's not about share, but it's about a more technical debt instrument, which is bond, which is a fixed income security to us.
Yeah, thank you so much again, Shane, for inviting me to do this particular webinar. I have actually learned a lot from this particular session when I'm preparing this thing.
Okay, cool.
So yeah, thanks for the chance to actually share what I have gathered and what I've known about this ETBS, and it's always a pleasure to be here.
Yeah, thank you everybody for tuning in tonight. This webinar is brought to you by Bursa Malaysia and managed by us Life Champ. All right, see you again next time. All right, next month in December. All right, Bye bye.
Bye bye.